Ticker symbol e.l.f. is down around 16% for the past year. Today we'll be looking at an explosive growth machine with over 59% year-over-year revenue growth, which has had consecutive quarters with net margin contraction. So today we'll be looking at none other than e.l.f. Beauty, a beauty product company. In their annual report, they state that they make the best of beauty accessible to every eye, lip, face, and skin concern. They basically deliver cruelty-free, vegan, and premium quality products at accessible prices with broad appeal. And just for you to get a sense of how accessible these prices actually are, one of their brands, which is e.l.f. Cosmetics, has an average product price point of $6. And according to an analysis done by Gartner, the average price of other mass cosmetics brands was $9, and it was $20 for prestige brands. So they are by far one of the most accessible brands when it comes to cosmetic products. Just by looking at the product branding, they don't seem cheap at all. They actually seem like premium quality products, and it's surprising that they sell for such low retail prices. In 2023, they were actually named to Fast Company's list of the world's most innovative companies of the year. This was because they were a leader in speed and first to mass product introductions. In their annual report, they actually believe that the brand awareness for this company is extremely low and hence are spending currently around 25% of their net revenues in marketing and digital efforts to get their name out there and increase their exposure. And this is one of the main reasons why they have been growing at such fast pace. Now, since the majority of these products are actually sold at other retailers, Target, Walmart, and Ulta Beauty accounted for 25%, 17%, and 16% of the total sales of the company for the fiscal year of 2024. And when we look at their financial analysis, it does not look that bad to be an accessible product company. They have a very solid return on capital employed of 14%, which is just under our threshold of 15%. But since it's a growing company, this should grow in the future. Then they have an interest coverage ratio of 11 times and a cash conversion ratio of 87%. They have a very nice profit margin of 71% and a low operating margin of 9%. But this is a typical issue for companies which are focusing on lowering their prices as much as possible and finding that as their differentiated offering. This is what I was talking about. Just look at this explosive growth. It looks like in 3-4 years, they have actually managed to times their revenues by 3. The only issue here is that their net margin actually started decreasing since September 2023 and hasn't stopped doing so yet. So while their revenue has grown by an impressive 59% year over year, their net income has actually decreased a little bit. And when we look at their efficiency ratios, these usually follow net profit instead of revenues, so as a consequence, these have also been decreasing, with their return on invested capital being at around 27%, which is still a pretty decent number. And when we look at leverage analysis, we can see that in 2024, they conducted an acquisition, and this actually raised both their total assets and their total liabilities to actually be able to perform this. However, this did not affect their current ratio very heavily, and this is one of the reasons why their return on capital employed appears so low currently, because they had a big influx of total assets while their net profits haven't increased yet. And this honestly may be one of the reasons why their margins have actually decreased. But when we look at their fundamental analysis, we can see that this company is doing okay, but they get a 3.5 out of the 8 possible ticks. Starting off with the fact that they have very low liability risk and they have a very solid balance sheet as they can pay all of their short-term liabilities only by using their current assets. Now, additionally, there is no issue with this company's revenue growth and they're able to grow this organically. However, I am not too keen on their free cash flow as they haven't been able to actually prove that they can grow this organically and it's not consistent at all. Additionally, this company does not pay out any dividends and they are actually not conducting any share buybacks yet. And when we look at the two most important factors in this slide, which are pricing power and the existing moat or competitive advantage, sadly, we can only argue for the competitive advantage. I do not believe that this company has pricing power because pricing power to me is defined as when a company is able to increase their prices at above the rate of inflation without actually losing too many customers. And this is actually the problem with a lot of these companies that actually try to differentiate themselves only by offering a lower price. In the case of e.l.f. Beauty, I don't think they have a lot of room to run to increase their prices because although they may be able, the kind of consumer that they're attracting to their brand is that one who is highly price sensitive. And that means that whenever you start to increase your prices, there will be a point where you will start to lose the majority of these customers, which is not a great position to be in. But then when we move at their existing moat and competitive advantage, I put this at a maybe, because while yes, they're offering very unique products, very unique brands which are being recognized, and they're having a lot of success worldwide, it's difficult to tell whether this existing moat is because of the product quality or because of the price. If it's because of the price, I would not classify this as a competitive advantage, as there are very, very big players which I'm sure that can actually conduct and produce these products at a lower cost than e.l.f. Beauty can. However, if you're telling me that this is due to the quality of the product, then I would argue that this could possibly be an existing moat or competitive advantage. And since I'm not an expert on this topic, I will let you decide. Now, when we look at their valuation analysis, of course, this company has a lot of hype due to its explosive growth rate, and they're currently trading at a PE ratio closer to 70 times. This looks like it's a bit over their average of the past 3 to 4 years. But when we look at their free cash flow yield of 0.29%, this is a lot lower than the long-term inflation rate, which may suggest that this company is overvalued. However, this is because this company is not focused on generating free cash flow at all at the moment. But now when we look at risk and possible challenges, my main one is of course going to be the worsening competitive landscape. And this is because when you're competing on price, it's difficult to actually differentiate your offering from others. And at some point, a company can actually come in and undercut your prices, and you can be in big trouble if that was your only differentiator. However, in terms of e.l.f., I think they have more going for them than just the pricing, but this industry is extremely competitive, and the fact that they currently have around 50 or 60% of their sales distributed in only 3 big retailers is a bit risky, and I would like to see this improve. But now when we look at their not meeting performance objectives, this again is mainly due to their margin decrease for the past 4 quarters. I'm not a fan of this, and before investing or actually considering owning this company, I would like to see their margins actually stabilize. Now, before we move on, please remember that I'm not a financial advisor and this is not financial advice, so please do your own due diligence. However, I believe that this company does not have a strong competitive advantage. It does not provide consistent cash flows and they're not growing, but it has an okay return on capital employed. So while I believe that this could be a good company and a good investment, the thing that pulls me back is that they engage in heavy price competition, and I'm not sure I want to invest in a company whose main differentiator is that. So anyways, having said that, thank you for watching. As always, this has been the Cashflow Compounder. Join the free Patreon for extra content, and I'll see you in the next one.